Hi guys, welcome to this new session of CFA Level 2 Equity. Today we'll be covering the remaining portion of our reading Multiples Based Valuation. So in the first reading itself, we did a lot of the basics. In fact, our entire focus was on the PE multiple itself. So not only did we cover PE multiple in detail, but along with that, we also covered some of the concepts which are easy to replicate in all the other ratios as well. Something like how exactly do we compare two companies, whether one is priced well or the other is priced well. That analysis we did with the PE part itself, but it is easy to replicate the same with all the other ratios. So in total, your entire reading focuses on about 6 ratios. We've already covered the basic one and also the most detailed one, the price to earnings multiple, in the previous session. Today's agenda would be to cover all the remaining portions. So let's start with the first formula or the first multiple that we have for today, which is going to be price to book multiple. Now, the basic formula for PB multiple is fairly simple. It is price per share divided by book value per share. Now, this book value, this is calculated as simply assets minus liability minus preferred capital, if any. So effectively, we only need book value of our common stock. That has to be exclusive of preferred capital. Now, all of these values, they will have to be picked out from the balance sheet. So effectively, book value is how much the equity portion of my balance sheet is. That's what we are concerned with. So if you take all these asset, liabilities, preferred capital, at the value at which they are appearing in the balance sheet, the book value of all of these things, you would end up with the book value of equity shares. And then you simply divide it by the total number of shares and you get book value per share. Now, the way this calculation works is fairly simple. It's simply telling you that against the actual assets and liabilities that the business has, what exactly is the difference between the value of equity shares as per the assets and liabilities that a business has versus the actual market price, which is representing the effect of demand supply forces in the market. Aside from the change in ratio, in fact, from PE multiple, most of the ratios would have just a simple change that the denominator would change to something other than earnings per share. So over here, we have book value per share. And examples, calculations, exactly same the way we did for the PE multiple. Two kinds of questions you could get here. One is to calculate this ratio itself, where the question would give you information about price per share and book value per share. And the other kind of question is that it would give you some sort of industrial PB benchmark and it give you your book value per share to estimate what the price should be. So either ways, you should be comfortable. Let's just do a quick example to just cover this calculation up. So let's say the price of share is $50. Total assets is $100,000. Total liabilities $30,000, and number of shares is 10,000. Calculate PB ratio. So just pause the video, give it a try, see if you can calculate it. Now, if we start with the answer, with the solution of this, we already have the price given. So for PB multiple, we need price divided by book value. This price is already given as 50. We need book value. Now for book value, we have this equation that the total book value of equity can be determined by assets minus liability minus preferred capital. Now we don't have preferred capital information, so we'll assume that to be 0. So you have total assets minus total liabilities. So the book value per share is going to be 100,000 minus 30,000 divided by number of shares, which is 10,000. So when you solve for this, you'll get book value per share of about 7. So your actual calculation comes out as 50 divided by 7. And then you can solve for that, you'll get approximately 7.14 as your PB ratio. So basic calculation.